So I'm going to run through an example here, and we will see exactly what leverage can do for us in real estate. And then I know you'll have some questions. So as we go through this, throw them in the feed. So where's my pencil or
right
my
here.
pen? Okay.
Your pencil.
All right.
You want your
So
pencil.
we have two examples we're going to run through. Okay. So we have one guy and his name is Sean. Okay. So let's, oops, sorry. So we have Sean. All right. And he's an investor. Okay. And then we have also.
But Sean, like, he's a really, really good guy. Super great. He's from the East Coast. He's a wonderful guy. Pretty funny. But he's not that savvy of an investor. You know, like he's great, but you know, he might. And then we're going to invest. Karen, actually.
Okay.
Karen is going to invest the better way. So Karen is pretty savvy. She knows what she's doing. She thinks ahead. She's got her stuff together. So Karen is going to be investing the more savvy way, and Sean's just going to invest, you know, the normal Sean kind of way. So that's the scenario we're going to run through.
Okay. So scenario number one, they both have the same amount of money. And now we're talking real estate here, okay? So we're going to talk about a little bit bigger numbers. We're going to buy a piece of real estate, an average piece of real estate across Canada is somewhere between $400,000 and $600,000. So let's just pick $500,000, okay? So they both have $500K. Now, let me know if you guys can see this on the whiteboard, okay? I want to make sure that you're able to see this. So they both have $500,000 to invest.
We can, but it's way high. But oh well, whatever. Who cares?
Okay.
Okay, we each have $500,000 to invest. So, cash?
Yes.
Okay.
Okay. So now, Sean, and this is the question we get all the time.
I'm going to move out of the way.
Yeah. So if we have $500,000 to invest, what are we going to do with that? Now, if I bought one house, so let's say Sean goes out and he buys a good, beautiful little rental property. Okay. It's got a nice little chimney and there's smoke coming out and the snow is falling. Okay. So it's a nice little rental property. All right. Now, this is a cash flowing property. He rents this one for $3,000 a month. Okay. 500,000. After his expenses, he cash flows on it definitely because he doesn't have a mortgage on that. He buys it free and clear. Okay. Somebody puts $500,000 down on a property free and clear. Okay. Then Karen also does the same thing. Karen buys the exact same property next door. Okay. It's also beautiful. All right. Got a chimney and it's a gorgeous little property, but Karen does something a little bit different. Okay. Karen uses leverage. Now, this is the point that we're trying to get across here. All right. So Sean used his $500K, bought the property free and clear.
Okay, just wait. I just have to make one comment. So I see someone says, who has $500K to start? Right?
Yes.
None of us have $500K to start.
Yes.
For sure. However, the principle of this, we're going to break it down into
Yes.
real life after, but the principle
Yes.
of it.
Don't get stuck on the number right now.
Yeah.
Okay.
Best
So
dealt with here.
what
You'll
we're
see.
doing is just showing how real estate gives us leverage when
Yeah.
we're investing. Okay. And that's the point that we're trying to get across. So don't focus on the $500K right now. We will get to that in a little bit. Okay. So Karen also has that same $500K to invest. But what she does is she goes out and puts $100K down. All right. And she gets a $400,000 mortgage. Okay. Now there's a difference here between the two. Sean put his $500,000 on the house, bought it free and clear with no mortgage. Karen put 20% down, which is the standard here in North America. It's the standard here in Canada. If you put 20% down, you have to put 20% down if it's a rental property. You can put less if it's your personal residence, but if it's a rental property, you have to put a minimum of 25% down. Now, some people put 25, 30, 35% down, but 20% down is kind of the industry standard. So Karen's doing a great job of leverage here, okay? So she puts 20% down, which is $100,000. Now, in real estate, we want the market to go up, right? That's kind of the whole point of buying a piece of real estate. We want to get three things from it. We want to get cash flow on a monthly basis. We want to get mortgage pay down, and I'm going to show you in a minute why that's important. And we want the market, hopefully we're buying in a market that's going to go up in value, okay? So now over the last 50 years in North America, all over Canada, the United States, on average, real estate has gone up just over 5% per year. Now remember that. It's gone up just over 5% per year. Now, does that mean that every year goes up 5%? Absolutely not. Some years it's gone up 2%. Some years it's gone up 9%. I remember back in 2007, 2006, it was going up 20% in a month here in our area. But then sometimes, some years, it goes negative as well. So some years it can go -5 or -10%. But the point is over a 50-year period, on average, in a long time span, it goes up roughly over 5%. But what we're going to do is just use a little bit more conservative a number, and we're going to say that Sean and Karen both bought in a good market. They both bought in a market that is going to go up 4% in a year, okay? So it's going to appreciate by 4%. So now let's take Sean's example. Sean paid $500K, it goes up 4%. What's the value of that property after 1 year? The value of that property going up 4% is $520,000, okay? So what did Sean make? Sean, in this case, made $20,000 profit.
That's great.
It went up. It's good.
Yeah.
He made a 4% return on his money, which isn't bad at all. Okay, so let's now compare that and show the power of leverage when we look at Karen. Karen bought the same property for $500,000, but because she only put $100,000 down and she got a $400,000 mortgage from the bank, and now her property's in the same neighborhood, remember, same property, and it goes up to $520,000 as well. She also makes a $20,000 profit. But what's the difference? In this case, in Sean's case, he's making a 4% return on his money.
ROI.
Or return on investment. In Karen's case, because she only put $100,000 down, she's making a 20% return on her money. Okay, so that is really where it all starts. That's the concept of where all of this real estate investment stuff starts, is the less money we put down, if we make the same return, 20,000, but we put less down, then our return on investment goes up significantly. Okay? So we're going to pause there for a second. And I want to know whether any of you have any questions. I want to know, what are you thinking? Does this make sense? Is this confusing?
I'm just going to throw this out. This is ROI, and the difference is the fact that some of it was leveraged and she's using some of the bank's money.
Exactly. Yeah. Other people's money. We talk about that all the time. OPM, or other people's money. When we use other people's money to invest and we make a profit on it, then that increases our return on investment, right? And in this case, other people is the bank, because we are making a return on the bank's money. The bank is giving us money, and yes, we pay interest on it, but we're making more money than the interest we have to pay. Okay? So that's really where we can make more money in real estate. That's why real estate is so powerful, because any other stock, okay, or any other investment.
So do it.
So let's say I bought I had $500,000, same thing, and I invested in a stock. I invested in a mutual fund. Any of those types of things. And it goes up, let's say the stock goes up 10%. I make $50,000 in that case. Goes up 10%. What is my ROI? 10%. Is it as good ROI as real estate? Absolutely not. It's not even close. It's half. So a stock would have to go up 10% just to equal this example. Because you're using all of your own money. You're not using someone else's money. You're not using the power of leverage. Okay?
So why do we need to know this? For one, it's a huge reason why real estate becomes the #1 investment vehicle for most people. Because you're putting in a little bit, again, that leverage. Think of that lever that you're trying to pop a nail out of a piece of wood with. You know, that lever, you're putting minimal effort for maximum result. You're putting little down for maximum return. And the way you do that is by using the bank's money, because your return comes on the full amount, the full $500,000 investment, whereas your return here only comes on the money that you actually put down. So here we're making an ROI on money from the bank that we didn't even use. We didn't have to come up with. We just borrowed it. So the power of leverage, why is it important? Because for one, it reconfirms for us that, it's a stable, smart investment where the leverage is already maximizing our results for us, even when we're not, or even when the market isn't. However, the other beauty of this is the fact that you can tell your joint venture partners, you can explain to them really simply, and you can do it in a number of different ways, but you can do it by, comparing a stock. If you put, $50,000 into stocks, and it went up 10%, what would you get? You'd get $5,000. If you put $50,000 into real estate as a down payment, what would you get? That would be 20% of a, help me out there, $300,000 investment?
Yeah.
Through like a $260,000 investment. That goes up 10%, you get $26,000 back. So, the same money, but you're getting way more money back for the little that you're putting in. So again, maximizing your results. So when you're able to show that to people that you're talking to that are interested in real estate, but don't necessarily know the details of it or understand why it's powerful, it's a huge benefit to you to be able to explain this.
Now, here's the key to all of this, okay? So we've kind of just simply touched the power of leverage. But now there's so much more to this, okay? So Sean spent all his money on this house for $500,000. Goes up, he made 20 grand, he made a 4% ROI. Good for Sean. Karen, in this case, made a 20% return on investment, but how much of her $500,000 did she invest? She only invested $100,000, okay? So she still has $400,000 more to invest. Now, Karen can go and buy house number 2, house number 3, house number 4, and house number 5, assuming they're all priced at the same amount.
For the same money.
For the same money.
That she could have bought one cash.
As Sean bought one. Now, she puts $100,000 down, 100 on each of these, plus her 100 here. She now owns 5 houses. She owns $2.5 million worth of real estate. Now, here is where it really starts to get cool, is that because she owns $2.5 million in real estate and it goes up 4%, now she's making $100,000 of return in this case. So Sean,
time,
bought one in the same exact time.
With the same amount of money down.
Same amount of money, bought it free and clear, and made 4%, just like any other investment. Bought it $500,000 worth of mutual funds, $500,000 worth of real estate, $500,000 worth of stocks. It doesn't really matter. You just get a return on whatever the market gives you on all the money you put in. In this case, Karen is leveraging her money. She's using the bank's money to make money, and she's able to buy 5 houses, $2.5 million worth of real estate. And now she's making $100,000 in that year, where Sean is only making $20,000.
With the same money down. You have to leverage, you have to get a mortgage, you have to go to the bank, you have to qualify, yes. But it's the same cash down. And now Karen has gone from, putting her 100K down, she's doubled her money in a year, whereas Sean has, made 4% ROI, which is okay, and that's good, and that beats a lot of, stocks out there and mutual funds. But which one? So just for fun's sake, especially our Igniteds, who do you think is smarter? Would it be Karen or would it be Sean?
Mm-hmm.
Who's smarter?
Who would you invest with if they brought this concept to you?
Or Sean?
Yes. Okay. Good. Awesome.
I hope he's watching. I really hope he's watching.
All right. So let me have. Do we have any questions in the comments at all?
Yeah, we do have a couple questions. Okay. You've already gone through some of them. Some of them are a little bit longer, so I didn't actually get to read them. But one of the questions is, what about the cost of borrowing?
Cost of borrowing. Okay. All right. So guys, here's the key, and this is
Here's
the
the
cool
beauty.
part. This is what I really like about this. If we compare Sean and Karen's investments, okay? So let's compare. Let's say that this house, all 6 of these houses are gonna rent for the same amount, okay? They're in the same neighborhood. They're gonna go up the same value. We're comparing apples to apples here, okay? So in this case, Sean bought it free and clear, $500K, has no mortgage. So our initial thought is, well, he's gonna cash flow way better because he doesn't have the mortgage, right? Okay. So what does he still have to pay though? He still has to pay property taxes, he has to pay insurance, repairs and maintenance, vacancy allowance, all of those sorts of things, okay? So if we're being conservative and giving property management, if we're being conservative in some of those numbers, and remember he's giving $3,000, hopefully you guys can see that, $3,000 per month in rent. You take off those expenses I just talked about, property management, repairs and maintenance, vacancy, and we take off taxes and insurance, that all totals, let's say, roughly about $825. So I did the math on this earlier just to compare apples and apples, okay? So in this case, Sean is going to cash flow $2,175 per month, okay?
Just so you know, everyone's voting Karen.
Voting Karen, awesome.
Karen is smarter than Sean, right?
Okay,
Yes.
You guys are clearly catching on quickly, so that's really good. Okay.
Trevor says, I know them both. I know the answer to this.
That's awesome. You know what? When I first started doing the math on this, when I first started thinking, okay, but Sean doesn't have a mortgage. Okay, so maybe Sean's right. And then I did the numbers, guys. Okay, so bear with me here. Sean's going to cash flow $2,175 a month, assuming the regular expenses. Now, if we assume the same expenses for Karen, okay, Karen in this house here, because now she has a $1,700 and some dollar a month. Sure.
Should we do a different
Let's do
color
a different
for cash
color.
flow?
Hopefully they can see it.
I think so.
Okay.
So this should be
this
21.
work? Yeah.
Can you want to do 2175 there?
2175. Let us know if you guys can't see that, okay? So Karen is cash flowing. Now, we have to remove the mortgage payment from that, and the mortgage payment in that case is roughly $1,700 for a $400,000 mortgage at 3.19%. With a 25-year amortization. Okay, a regular mortgage. In fact, a lot of you guys can get a lower percentage rate than that nowadays, but let's be a little conservative. She's going to, in this case, cash flow after the mortgage is also paid $450 on this house, okay, per month.
On that house
On
number
that house.
one.
Now
the first
remember,
year.
in the first year. Now remember, same with Sean, in the first year. So remember, Karen has 5 of these. Okay, so $450 a month, and this is the part that we sometimes forget. $450 a month times 5 months is actually $2,250 per month.
That's not in the picture on my phone. Sorry. No, you got to go higher.
$2,250 per month in cash flow. Okay, let's make that really important here, guys. $2,175 for Sean because he doesn't have a mortgage. Only $450 a house for Karen because she has mortgages. But when you get those 5 houses together, she's cash flowing more money a month using the same property taxes, the same insurance, the same property management, repairs and maintenance, and vacancy allowances. The only difference is she has mortgages to pay.
Now,
She's actually cash flowing more. Now, there's more to this. Okay, that's just the start. This is why it's so exciting, guys. And I hope that you guys start remembering this and be able to explain this to others and listen to this over and over again because it's really exciting. Okay, so that answers the question. First of all, if any of you thought, well, he doesn't have a mortgage and she has mortgages, so he's doing better.
He's going to cash flow better, right?
No, Karen is doing better cash flow wise. Now remember.
Okay. Should I just interject
Okay,
with
yep.
lifestyle?
Sure.
So let's remember, Karen's working harder for this money, for sure, right? She's having to, manage 5 tenants instead of 1. She's got 5 roofs, 5 furnaces instead of 1. So she is working harder for it, absolutely. Is she, making more money in her return on investment? She's made $100K this year, where Sean has made $20K. and they're cash flowing about the same, let's say. So she's working harder for it. But that's in the first year. Remember, the cost of borrowing goes down as time goes on. As our mortgages get paid off, the cost of borrowing goes down.
Ah, you just touched on the next point.
Sorry.
And that's a big point. No, that's okay. Can I get another color?
Red.
Do we have another color?
Red is negative, but it shows up best.
Okay,
I
let's
feel
use
like
red.
red is negative. But,
well, we're going to talk about a mortgage, so let's use red, okay? So
right.
here's the dealio, all right? So Sean didn't have a mortgage, remember, okay? So he's getting $21.75 a month into his pocket. Good for Sean. Karen is getting $22.50 in her market, or per month into her pocket. Good for Karen. But what else is Karen getting? Out of those expenses, Karen is getting her tenants, because she's paying a mortgage payment every month, her tenants are also paying down a mortgage for her, okay? So if you look at any mortgage calculator, a $400,000 mortgage, 3.2%, 25-year amortization, $9,000 is paid off in the first year. So Karen also gets, so let's say $22.50 per month times 12 months. Go back to the cash flow.
Move this out a little.
Okay, just check the camera to make sure it's still okay.
Yeah.
She's making $27,000 a year in cash flow. Can you see the bottom here?
I'm just gonna turn it this way. I believe now we've got a better picture.
Okay. And in this case, Sean, $21.75 times 12 equals $26,100 in cash flow. Okay. So more for Karen than for Sean, but now Karen also has $9,000 per property, okay? Per property times 5 properties equals $45,000 in mortgage pay down. I don't know if you guys can see that on the board, but that's an important number. $45,000 in mortgage paydown that Sean does not get because he doesn't have mortgages on it. Yes, he's getting cash flow in his pocket on that one property, but Karen is also getting her mortgages paid down and cash flow in her pocket. So way, way, way better. Plus she has 5 properties going up in value. So she has her $100K plus her $27K plus her $45,000K, she's got a total of $172,000. Okay, let's make this number big. $172,000 of profit in her first year, assuming the same numbers as Sean here is getting his $20K plus his $26,000, he's getting $46,000. Okay, do you see a difference, guys, in these two numbers? This is the power of leverage. When somebody says to you, well, what about the mortgage? This is what you show them. You show them real numbers. Now, if somebody has $500,000 to invest with you and you say, listen, I'm going to put that in 5 houses instead of 1, and this is why, what do they start to think? This person kind of knows what they're talking about. I never thought of that before. I'm going to trust my money with this person. Okay?
So when you teach and when you become an expert in what you're doing, people start to realize that you know what you're doing and they have confidence in your credibility and in giving you their money to invest. So we've had a couple of other questions. Okay. So one of them was, does anyone have that $500,000 again to start? No, not necessarily. But for those of you that don't know us, we're Corey and Tiffany Young. We started, building our portfolio back 18 years ago. We had no money. And so we partnered with other people that did have money. So did we have $500,000? No. But did we go out and meet and talk to people and explain and educate them on things like this? And did they give us that $100,000 to go buy that house? Absolutely. So we were able to do that over 100 times. With partners. Again, we had zero money. We were able to do that over 100 times and buy over 100 houses. That all of these things, the mortgage paydown, the cash flow, the ROI, all of those things kicked in for us as working partners. They gave us the money, we did the work.
And so what we do now, guys, is we teach you how to explain this. And if you can explain it simply and without complication. And if you can show how the numbers vary, and if you can answer somebody when they say, oh, well, what about the mortgage? And you can show them this.
And what about the cash flow?
And what about the cash flow? And you can show them this.
Let me tell you something. For those of you that know me, I am not a numbers person. I know we have quite a few new people in Fearless right now, so this might be your first training with us this week. So welcome, for one. But for two, welcome also to the fact that I'm not a numbers person. But I can tell you that I did, through practice, and I mean practice, sitting down, pretending I was talking to someone. There was no one on the other side of the table from me, but pretending I was talking to someone and going through and, drawing this out and explaining it and thinking of all the questions that they're going to ask me. I was able to explain this to them multiple times over and over again. And that moment where people go, wow, that's pretty cool. That's when you know that you've got some major interest and you have the ability to help them to get more out of their money than they're going to be able to get in mutuals or stocks or Forex or Bitcoin or any of that other stuff on a consistent basis. So it's this kind of stuff. Now, does this get complicated? Yeah, it can get complicated. Are we trying to rush through it in a half hour? Absolutely. Do you have to sit down and explain every bit of this? No, because your typical person isn't going to have all of those questions at their fingertips or at the tip of their brain immediately. Like we have, 100 people, 91 people sitting here on with us. So people are asking questions like this, right? You're not going to get all these questions at once. But when you go over it and practice it as if you are, you'll be amazed how, drawing these pictures and all this stuff, it actually comes out to really being helpful in establishing you as that expert.
And very, very helpful to actually work this out on a piece of paper for yourself, okay? You're seeing this today. We're showing it on a whiteboard today, but throw this on a piece of paper yourself. Run the numbers. Use a mortgage calculator. Figure out what the property taxes on a 500K would be. Figure out all of these numbers. What kind of properties out there? I mean, there's a lot of variables here, guys, in this example. For one, you find a $500,000 property that's going to have to rent for $3,000 a month. Can you find those in your area that you're investing in? And if not, can you find another area to invest in? There's a lot of variables in this, but the point of this, guys, and I don't want you to get stuck too much on individual numbers in this example. I want you to understand the concept of leverage, the concept of using other people's money or using the bank's money to invest. And that's the power of real estate versus any other type of investment out there.
Yeah.
Is there's nobody else is going to give you a mortgage to invest in something else other than mortgage.
There's no one that's going to give you
real estate.
80% of their money. A bank is not going to give you 80% of their money to go and invest in stocks and allow you to put 20% down. That's just not how it works. If you want to buy 100% worth of stocks, it's 100% your money or a line of credit or whatever. But it's not going to be leveraged. They're not going to give you that minimal in for maximum results. So we do have a couple other questions. So one of them is Anne. So Anne asks, so does Karen get a commercial mortgage? She could get a commercial mortgage because it's 5 houses or more or 5 doors or more. So she could, but she could also get single family mortgages and that would work just fine, just the same. Remember, the point is there that the tenants are covering the mortgage and then some. So you're not doing this on a property that's not cash flowing. You're doing your homework. You're finding the right area, which again is in different trainings that we've had. You're finding, analyzing that property properly. You're making sure the tenants, what they pay you in rent is overly compensating for all of your expenses and then some. So you're cash flowing on these. So it doesn't really matter what kind of mortgage you get. It's just that you do have, indeed, you're using some of the bank's money, but yet getting returns on the whole amount. Another question for you.
So look for the questions. I just wanted to add in here what the return on investment is, okay? Because, we talked about the number amount, $46,000 for Sean in this scenario and $172 for Karen. Now, remember, Karen, they both have the same amount of money in. So earning $46,000 on a $500,000 investment gives you a 9.2% ROI, okay? Hopefully that's clear enough, 9.2% ROI. Now, not a bad return on investment. A lot of people will take 9 or 10% return on their investment. But in this same scenario where Karen is making $172K because she has the mortgage pay down, she has higher cash flow, she also has a higher amount because she bought more real estate, so she has a higher lift in equity. She is actually making, any guesses? 34.4% ROI. So a 34% return or a 9% return.
This is in 1 year, remember?
And that's just the first year of owning this property, assuming these conditions that we've talked about. So that's the whole concept, guys, that we wanted to share with you today. Just the concept of leveraging yourself and the power of it in real estate. And if you can explain that clearly to somebody, then there's a lot of people out there, and believe me when I say this, there's a lot of people out there that will now invest with you because, why? Because you can explain this clearly, because you can show them that they can make a better return.
You're their vehicle
can
to help them do
qualify
that.
for these mortgages for you.
So that's one of the questions that we had. Was, so how does Karen qualify for all 5 of these mortgages?
Good question. Yes. Now, some people can qualify for 5 mortgages on their own,
but most
especially
of us
some
can't.
people who might have $500,000 in their pocket.
Right.
But if you're not one of those people, and a lot of
like
us,
the
when
majority.
then we don't have that sitting around, right? So what do we do now? We go out and find people that can qualify for these mortgages and can put these down payments down, and we partner with them.
So this one might be owned by Melanie. This one might be owned by Stacy. This one might be owned by Danuja. And they've qualified. So Robert, for your question, Melanie has qualified on this one and put down the 100K. Stacy's qualified on this one and put down the 100K. Danuja on that one and put down. So we're not having to go out and qualify on all these mortgages, nor are we having to come up with the cash for it. Again, we were 24 years old. We couldn't do either of those two things. Yet we were able to buy over 100 properties by finding people who were able to, that didn't have the time to manage properties, didn't have the expertise or the education to understand this kind of stuff. But when you're able to explain it to them and they go, holy crap, you can actually do more with my money than I can, I'll invest with that. Not only that, because they're qualifying on the mortgage, title's in their name. So they own the house.
Right?
They have the security that is secured against land, and people really like that. So Robert, in answer to your question, how did Karen qualify on all those mortgages? She didn't. Her partners did. Does that mean that she's splitting? Because it's a 50-50 split usually. So she's giving them half the cash flow and giving them half the, annual return, not on an annual basis, but when they sell, they'll get half of all the equity they've made. So she's, getting half of that, let's say, if she doesn't have this. But if she doesn't have it, getting half of all this is better than getting none of it. So in our case, that's what we had to do.
In that case, when you're getting half of 34% return, your JV partner is still getting 17% return. And remember, guys, they're getting that based on the number they put in. But what are you getting? You, as the working partner in that scenario, are getting an infinite return because you're not putting any money in this scenario. Okay? You have a partner that's qualifying for the mortgage. You have a partner that's putting the down payment, and you're doing all the work. And that's the whole concept of joint venture.
I'm just going to put Barb's name in here right there.
Barb, okay.
There we go. One is owned by Barb. Okay, so Chantal has a question. Do we have time for a question?
Yeah, of course.
Okay.
I think.
Yeah, we do. If you had an opportunity to purchase a property with seller financing with 20% down, would you go this road alone without a JV partner and then borrow the down payment 20% from a private lender if the numbers worked? At the end of the day, if the numbers work.
If the numbers worked, absolutely.
If the numbers work. But you would be really careful to make sure that you analyze it really closely to make sure those numbers do work. Make sure your rents that you're getting from the market are tried and true. Get out there and make sure you know what that property is actually going to rent for. Make sure that you're going to get a certain rate on your mortgage. All those kinds of things. Make sure to put in a vacancy allowance. So, is the area normally, 5% vacancy?
Yeah.
Maintenance allowance, all those things. So make sure to count in all. And if the numbers work.
And here's the key in that scenario, what's her name? Chantal. If you have seller financing in that case, and they're pretty much doing 80% of the financing, I would still bring in a joint venture partner on that scenario, because here's the key. The key is for a joint venture partner now, they don't have to worry about qualifying for the mortgage. All they need to do is bring the money down. if the seller is providing that. So there's a lot of people out there that have money to invest, but for one reason or another can't qualify for another mortgage. And so you're now broadening the amount of potential JV partners that you could market yourself to. And I would bring one of those in that particular scenario. The numbers might be a little bit less in that scenario, but still a win for a potential partner.
Everyone's like, yay, this is exciting. Okay, so guys, tell me, who thought going into this scenario that by putting $500K on this same house, by Sean putting $500K down, paying it off, who thought that there was going to be more cash flow than Karen going out and getting mortgages and putting only 20% down? Who thought that there was going to be more cash flow on Sean's side of things than by doing it with leverage, with debt, with something that to me, when I came into real estate, it was a no-no. I didn't believe in credit card debt. I didn't believe in overdrafts. I didn't believe in any of that. It was like, if I didn't have the cash for it, and I didn't have any cash, but I certainly didn't have debt, because that freaked me right out. Who thought that this was going to be the winner? Sean was going to be the winner, when really Sean ended up being the major loser. Like, the big loser was Sean, and the major winner, I don't even think they're on. This is such a waste. But who thought that it was going to be the other way?
I'm not talking about anyone in particular. These are just the names that came to mind.
Oh, you didn't plan it that way.
No.
I see.
No one in particular. I was just thinking they're good names for this scenario. So.
Yeah. Yeah, see, everyone's saying, yeah, I thought that Sean was going to come out the winner. But now, when you break down the numbers, and that's why analyzing the numbers in anything is so important.
I'll be honest, I didn't know the answer to this when I started this morning.
Just to the cash flow part, you mean?
Yeah.
To the leverage you
to the cash flow part.
Just to the cash flow.
I thought that Sean would out cash flow Karen by 1,000,000 to 1. But when we start looking at these numbers and we realize that there's just not one house. Okay, yeah, so one house Sean cash flows more than Karen's one house. But remember, Karen's buying 5 of them. So you put that together and now she's cash flowing more. I'm like, absolutely. There's no question we can see the power of leverage in this scenario. And so hopefully that makes sense for you guys. Hopefully that clarifies a few things.